quick note: this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. When most traders think about risk, they think in terms of individual trades. They ask how much they might lose on a position, whether the stop is too wide, or whether the reward justifies the risk, though that is surface level thinking. Professional traders think in sequences, not in isolation. The real question is not what happens on the next trade, but what happens across the next 100. This is where the concept of risk of ruin becomes central. Risk of ruin is the probability that your trading strategy, combined with your risk management, will eventually lead to a complete loss of capital. It is not theoretical, it is a mathematical certainty if your structure is flawed. You must understand that markets are probabilistic environments. Even if you have a genuine edge, you will experience losing streaks. Those losing streaks are not anomalies, they are built into the distribution of outcomes. The mistake most traders make is underestimating the length and severity of those sequences. They assume that because their strategy wins 60% of the time, losses will be evenly distributed. That assumption is false. Losses cluster, they arrive in bursts. And if your position sizing does not account for that, your capital will not survive long enough for the edge to play out. Risk of ruin is therefore not about being right, it is about staying alive. It forces a shift in thinking from short-term outcomes to long-term sustainability. You are no longer asking whether a trade is good. You are asking whether your overall structure allows you to endure the inevitable periods of underperformance. That is a completely different mindset. It is not reactive, it is structural. The professional approach begins by accepting one uncomfortable truth. You cannot eliminate losses. You cannot eliminate drawdowns. What you can control is the magnitude of damage those events inflict on your capital. And that control is the difference between a trader who survives and one who disappears. To understand risk of ruin properly, you need to think in terms of probability distributions. Every trading strategy can be described by three key variables: win rate, average win size, and average loss size. These define your expectancy, but expectancy alone is not enough. Two strategies can have identical expectancy and completely different survival profiles. One can sustain long losing streaks and recover, the other can collapse under the same conditions. The difference lies in how risk is allocated. Consider a simple example. A trader risks 5% of their capital per trade with a moderate edge. On paper, this may appear reasonable, but now introduce a sequence of 10 consecutive losses. This is not extreme, it is entirely possible. After 10 losses at 5% per trade, the account is down roughly 40%. At that point, the psychological and mathematical recovery burden becomes significant. To recover from a 40% drawdown, you need approximately 67% return. That is not trivial. It changes behavior, it introduces pressure, and pressure leads to mistakes. Now contrast that with a trader risking 1% per trade. The same 10 loss sequence results in roughly a 10% drawdown. Recovery requires just over 11%. The difference is not marginal, it is structural. One trader remains in control, the other is operating under stress. This is the essence of risk of ruin. It is not just about the probability of losing everything in one catastrophic event. It is about the cumulative impact of repeated losses and whether your structure allows for recovery. The mathematics is unforgiving. Large losses require disproportionately larger gains to recover. That asymmetry is what destroys accounts over time. Professional traders design their risk exposure around worst-case sequences, not average outcomes. They assume that the worst cluster of losses will occur, and they ensure that when it does, the account remains intact. This is not pessimism, it is realism. One of the most dangerous misconceptions in trading is the belief that a positive edge guarantees long-term profitability. That belief ignores the path dependency of returns. The sequence in which wins and losses occur matters. Even with a strong edge, poor risk management can lead to ruin before the edge has time to manifest. Imagine flipping a biased coin that lands on heads 60% of the time. Over a large number of flips, you will come out ahead. But if you bet too much on each flip, a short sequence of tails can wipe you out before the probabilities have time to work in your favor. Trading operates in exactly the same way. Your edge defines the long-term outcome. Your position sizing defines whether you survive long enough to reach that outcome. This is why professional traders separate edge from execution risk. They understand that having an edge is only part of the equation. The other part is ensuring that the edge can be realized over time. That requires controlling the volatility of returns. High volatility increases the probability of large drawdowns, which in turn increases the risk of ruin. There is also a psychological dimension. Large drawdowns do not just affect capital, they affect decision making. When a trader experiences a significant loss, their behavior changes. They become either overly conservative or overly aggressive. Both responses are damaging. Conservative behavior leads to missed opportunities. Aggressive behavior leads to further losses. In both cases, the original edge is compromised. By keeping drawdowns within manageable limits, you maintain behavioral stability. You preserve your ability to execute your strategy consistently, and consistency is what allows the edge to play out over time. Risk of ruin, therefore, is not just a mathematical concept, it is a behavioral safeguard. To manage risk of ruin effectively, you need to quantify it. This does not require complex models, but it does require disciplined thinking. You need to estimate the probability of losing streaks based on your win rate, and then assess how those streaks would impact your capital given your current position sizing. For example, if your strategy has a 50% win rate, the probability of 10 consecutive losses is low but not negligible. Over hundreds of trades, it becomes increasingly likely that such a sequence will occur at some point. The question is not whether it will happen, but when. Once you accept that, your focus shifts to preparing for it. Preparation means reducing position size to a level where even extreme sequences do not threaten your survival. It also means avoiding leverage that amplifies losses beyond your control. Leverage is often marketed as a tool for increasing returns, but in reality, it is a multiplier of risk. Used incorrectly, it accelerates the path to ruin. Another important factor is correlation. Many traders believe they are diversified when they are not. They hold multiple positions that are all exposed to the same underlying risk. When that risk materializes, losses occur simultaneously across positions. This creates the illusion of a single large loss rather than multiple independent events. From a risk of ruin perspective, this is highly dangerous. Professional traders manage correlation carefully. They understand that true diversification reduces the probability of large simultaneous losses. It smooths the equity curve, and a smoother equity curve reduces the risk of ruin. There is a critical relationship between drawdown and recovery that every trader must internalize. Losses compound against you, gains compound for you, but the asymmetry between the two is what matters. A 10% loss requires an 11% gain to recover. A 20% loss requires a 25% gain. A 50% loss requires a 100% gain. The deeper the drawdown, the harder the recovery. This is why avoiding large losses is more important than capturing large gains. It is a counterintuitive idea for many traders, especially those focused on aggressive growth. But the mathematics is clear. Preservation of capital is the foundation of compounding. Without it, compounding cannot occur. Risk of ruin is essentially the point at which recovery becomes statistically improbable. It does not have to be zero capital. In practical terms, a trader who loses 70 or 80% of their account is effectively ruined. The remaining capital is insufficient to generate meaningful returns without taking excessive risk, which further increases the probability of total loss. Professional traders aim to keep drawdowns within a predefined range, typically well below levels that would threaten long-term viability. This is achieved through disciplined position sizing, diversification, and strict adherence to risk limits. It is not about avoiding losses altogether. It is about controlling their magnitude. When you think about trading in this way, your priorities change. You stop chasing high returns and start focusing on stability. You recognize that consistent, moderate returns compounded over time are far more powerful than volatile, high-risk gains. And you understand that the only way to achieve that consistency is to eliminate the risk of ruin from your process. Another layer to consider is the impact of leverage on risk of ruin. Leverage magnifies both gains and losses, but its effect on losses is far more significant because of the asymmetry we have already discussed. A leveraged position increases the speed at which capital can be eroded. It reduces the margin for error, and it shortens the time horizon over which your strategy must perform. Many traders are drawn to leverage because it offers the possibility of rapid gains. What they fail to appreciate is that it also increases the probability of catastrophic loss. Even a small adverse move can result in a large percentage loss when leverage is involved. This creates a fragile system where survival depends on short-term accuracy rather than long-term edge. Professional traders use leverage selectively and conservatively. They treat it as a tool, not a default. More importantly, they integrate it into a broader risk framework. They ensure that even with leverage, the potential losses remain within acceptable limits. This often means using lower leverage than what is available, not higher. The key principle is this: if your strategy requires high leverage to be profitable, it is structurally weak. A robust strategy should be profitable at low levels of risk. Leverage should enhance returns, not compensate for a lack of edge. Risk of ruin also forces you to think about capital in a more structured way. Not all capital should be treated equally. Professional traders often segment their capital into different risk buckets. Core capital is preserved with conservative strategies and low risk. Tactical capital is deployed more aggressively but still within defined limits. This segmentation reduces the probability that a single adverse period affects the entire portfolio. This approach also allows for controlled experimentation. Traders can test new strategies with a small portion of capital without exposing the entire account to unknown risks. If the strategy performs well, allocation can be increased gradually. If it fails, the impact is contained. Another important aspect is liquidity. Illiquid positions increase risk of ruin because they limit your ability to exit when conditions change. Slippage becomes significant. Stops may not be executed at expected levels. This introduces additional uncertainty into the system. Professional traders prioritize liquidity because it provides control, and control reduces risk. Ultimately, managing risk of ruin is about building a system that is resilient under stress. It is about ensuring that no single event or sequence of events can compromise your ability to continue trading. That resilience is what separates professionals from amateurs. There is also a temporal dimension to risk of ruin. The longer you trade, the higher the probability that extreme sequences will occur. This means that even if your risk management appears adequate over a short period, it may be insufficient over a longer horizon. Time amplifies risk. This is why professional traders continuously review and adjust their risk parameters. They do not assume that past performance guarantees future stability. They recognize that market conditions change, volatility shifts, and correlations evolve. A risk framework that works in one environment may not work in another. Adaptability is therefore essential, but adaptability must be structured. It must be based on data and analysis, not emotion. When traders adjust risk based on recent outcomes, they often do so in a way that increases risk of ruin. For example, increasing position size after a winning streak or reducing it after a losing streak. Both behaviors are reactive and destabilizing. A professional approach maintains consistency in risk exposure. Adjustments are made deliberately based on changes in market conditions or strategy performance, not on short-term results. This consistency ensures that the probability distribution of outcomes remains stable over time. One of the most powerful shifts you can make as a trader is moving from outcome-based thinking to process-based thinking. Risk of ruin is fundamentally a process concept. It is not about individual trades. It is about the structure of your decision-making over time. When you focus on process, you begin to evaluate your trading in terms of adherence to rules rather than short-term results. You ask whether you followed your risk limits, whether your position sizing was appropriate, whether your trades were aligned with your strategy. This creates a feedback loop that improves consistency. In contrast, outcome-based thinking leads to inconsistency. Traders become overly focused on wins and losses, leading to emotional decision-making. This increases variability in returns, which in turn increases risk of ruin. By stabilizing your process, you stabilize your outcomes. This is why professional traders spend as much time refining their risk framework as they do developing their strategies. They understand that a strong process can withstand variability in outcomes, and it is that stability that ensures long-term survival. In the end, risk of ruin is the defining constraint of trading. It is the boundary within which all decisions must be made. Ignore it and no amount of skill or insight will save you. Respect it and you create the conditions for long-term success. The objective is not to eliminate risk. That is impossible. The objective is to manage risk in a way that ensures survival across all market conditions. This requires discipline, patience, and a willingness to prioritize stability over excitement. Every decision you make, position size, leverage, diversification, trade selection, should be evaluated through the lens of risk of ruin. Ask yourself whether this decision increases or decreases the probability of long-term survival. If it increases it, you are moving in the right direction. If it decreases it, you are introducing fragility into your system. Professional trading is not about making the most money in the shortest time. It is about staying in the game long enough for your edge to compound, and the only way to do that is to eliminate the possibility of ruin from your process. Now that the structural importance of risk of ruin is clear, the next step is to internalize how losing streaks actually behave in real trading environments. Most traders intellectually accept that losses occur, but they fail to model how those losses cluster. They imagine a smooth alternation between wins and losses. In reality, outcomes are uneven. You may experience 5, 10, even 15 losses in close succession, followed by a cluster of wins. This uneven distribution is not a flaw in your strategy. It is a natural characteristic of probabilistic systems. The critical mistake is designing a risk model that assumes average behavior instead of extreme behavior. Average behavior does not threaten your account. Extreme behavior does. Professional traders build their systems around worst-case scenarios, not best-case expectations. They stress test their strategies against sequences that feel uncomfortable, even improbable, because those are the sequences that expose structural weaknesses. Think about it this way. If your system cannot survive its worst plausible sequence of losses, then it is not a viable system. It may perform well temporarily, but it will eventually fail. This is why conservative position sizing is not a sign of weakness. It is a sign of structural awareness. It acknowledges that the future distribution of outcomes is uncertain and potentially volatile. Once you begin thinking in these terms, your perception of risk changes. You stop asking how much you can make and start asking how much you can lose without compromising your ability to continue. That shift is foundational. It is what transforms trading from speculation into a controlled process. Another layer that often goes unnoticed is the interaction between volatility and risk of ruin. Volatility is not just a measure of price movement, it is a driver of outcome dispersion. Higher volatility environments increase the variability of returns. This means that both wins and losses can be larger and more frequent. If your position sizing does not adjust accordingly, your risk exposure becomes inconsistent. Professional traders align their position sizing with market volatility. When volatility increases, they reduce position size. When volatility decreases, they may increase it. This keeps the risk per trade relatively stable in real terms. But no, it prevents the system from becoming overexposed during turbulent periods. Failure to adjust for volatility is one of the fastest ways to increase risk of ruin. A strategy that appears safe in low volatility conditions can become extremely dangerous when volatility spikes. Losses accumulate faster, stops are hit more frequently, and drawdowns deepen. Without adjustment, the system becomes fragile. There is also a psychological component here. High volatility environments tend to amplify emotional responses. Rapid price movements create a sense of urgency. Traders feel compelled to act, often abandoning their rules in the process. This behavioral shift further increases risk. By controlling position size in line with volatility, you not only manage financial risk, but also stabilize your decision making. This is the essence of professional risk management. It is dynamic, not static. It adapts to changing conditions while maintaining a consistent underlying structure. Let us now consider the concept of risk concentration. Many traders believe they are diversified because they hold multiple positions. However, diversification is not about the number of positions. It is about the independence of risk. If multiple trades are driven by the same underlying factor, they are effectively one trade. For example, if you are long multiple assets that are all sensitive to global growth expectations, a single shift in that expectation can impact all positions simultaneously. Losses occur across the board, creating a compounded drawdown. From a risk of ruin perspective, this is equivalent to taking a much larger position than intended. Professional traders analyze their exposure at a portfolio level. They identify common risk factors and ensure that no single factor dominates the portfolio. This reduces the likelihood of correlated losses. It smooths the equity curve and lowers the probability of large drawdowns. Correlation is not static. It changes over time, often increasing during periods of market stress. This means that diversification can break down precisely when you need it most. Professionals account for this by being conservative in their assumptions. They do not rely on perfect diversification. They assume that correlations will rise in adverse conditions and structure their risk accordingly. This approach may appear overly cautious, but it is grounded in reality. Markets are interconnected. Ignoring those connections is one of the fastest ways to underestimate risk. Another critical dimension of risk of ruin is time horizon. The longer you operate in the market, the greater the likelihood that extreme events will occur. This includes not only losing streaks, but also market shocks, liquidity crises, and regime shifts. These events are rare, but they are inevitable over a long enough timeline. Professional traders design their systems with longevity in mind. They do not optimize for short-term performance at the expense of long-term survival. This means accepting lower returns in exchange for greater stability. It means avoiding strategies that perform well under normal conditions but collapse under stress. There is a tendency among less experienced traders to chase high returns without considering sustainability. They focus on what is possible rather than what is probable. This leads to over-leveraging, excessive concentration, and ultimately increased risk of ruin. A sustainable approach recognizes that trading is a long-term endeavor. It prioritizes consistency over intensity. It seeks to generate steady returns while preserving capital. This may not be as exciting as aggressive trading, but it is far more effective over time. The key insight is that survival is the prerequisite for success. Without survival, there is no opportunity to compound returns. Risk of ruin is therefore the central constraint that shapes all professional trading decisions. Drawdowns are the mechanism through which risk of ruin manifests. They are the visible expression of underlying risk. Every trading strategy will experience drawdowns. The question is not whether they occur, but how deep they go and how long they last. Professional traders define acceptable drawdown levels in advance. They determine the maximum loss they are willing to tolerate and structure their risk accordingly. This creates a clear boundary within which all trading activity must operate. If the boundary is breached, action is taken. This may involve reducing position size, pausing trading, or reassessing the strategy. This disciplined approach prevents small losses from escalating into catastrophic ones. It ensures that drawdowns remain manageable and recoverable. It also provides a framework for decision-making during periods of stress. Instead of reacting emotionally, traders follow predefined rules. There is also an important feedback loop here. Drawdowns provide information about the performance of your strategy. They highlight weaknesses and areas for improvement. By analyzing drawdowns, you can refine your approach and reduce future risk. However, this process only works if the drawdowns are survivable. If losses are too large, the opportunity to learn is lost. This is another reason why controlling risk of ruin is so critical. It preserves not only your capital, but also your ability to improve over time. Let us now explore the relationship between risk of ruin and trade frequency. The more trades you take, the more opportunities there are for your edge to play out. However, increased frequency also means increased exposure to variability. Each trade introduces uncertainty. Over time, this uncertainty accumulates. Professional traders balance trade frequency with quality. They do not trade for the sake of activity. They focus on high-quality opportunities that align with their strategy. This reduces unnecessary exposure and improves the overall risk profile. There is a temptation to increase trade frequency after a series of losses in an attempt to recover quickly. This behavior is driven by emotion, not logic. It increases risk at precisely the wrong time. Instead of stabilizing the system, it introduces additional volatility. A disciplined approach maintains consistent trade frequency regardless of recent outcomes. It ensures that each trade meets the same criteria. This consistency is essential for managing risk of ruin. It keeps the probability distribution of outcomes stable and predictable. In essence, more trades do not necessarily mean better results. What matters is the quality of those trades and the consistency of execution. Another often overlooked factor is transaction costs. Every trade incurs costs, whether through spreads, commissions, or slippage. These costs reduce your net returns and can have a significant impact over time. In high-frequency strategies, they can erode the edge entirely. From a risk of ruin perspective, transaction costs increase the likelihood of negative outcomes. They effectively lower your win rate and reduce your average win size. This shifts the probability distribution in an unfavorable direction. Professional traders account for these costs in their strategy design. They ensure that their edge is robust enough to withstand them. They also optimize execution to minimize slippage and reduce unnecessary trades. Ignoring transaction costs is equivalent to overestimating your edge. It creates a false sense of security and increases the risk of ruin. By incorporating these costs into your calculations, you gain a more accurate understanding of your true performance. There is also a strategic element to managing risk of ruin. Different strategies have different risk profiles. Some are high frequency with small edges. Others are low frequency with larger potential returns. Each requires a different approach to risk management. High frequency strategies rely on consistency and tight risk control. Small deviations can have a large impact over many trades. Low frequency strategies, on the other hand, must withstand longer periods of inactivity and larger drawdowns. They require patience and a different psychological approach. Professional traders align their risk management with the characteristics of their strategy. They do not apply a one-size-fits-all approach. Instead, they tailor their risk framework to the specific demands of their trading style. This alignment is crucial for managing risk of ruin. It ensures that the risk framework supports the strategy rather than undermines it. Let us now address the concept of capital efficiency. While reducing risk is essential, it must be balanced with the need to generate returns. Holding too little risk can lead to underperformance, which in itself can be problematic, especially in a professional context. The objective is to find the optimal level of risk that maximizes returns while keeping the probability of ruin acceptably low. This is not a fixed number. It depends on your strategy, your capital base, and your risk tolerance. Professional traders continuously evaluate this balance. They adjust their risk exposure based on performance, market conditions, and strategic objectives. This dynamic approach allows them to optimize returns without compromising stability. It is important to recognize that there is no perfect level of risk. There is only a range within which the trade-off between return and risk is acceptable. Operating within that range is the goal. As this section concludes, the overarching principle becomes clear. Risk of ruin is not a single calculation or a one-time decision. It is an ongoing process that influences every aspect of trading. It shapes how you size positions, how you diversify, how you manage drawdowns, and how you adapt to changing conditions. Professional trading is built on this foundation. It is not about eliminating uncertainty. It is about structuring your approach so that uncertainty does not lead to failure. This requires discipline, consistency, and a deep understanding of how risk operates over time. When you integrate these principles into your process, you create a system that is resilient, adaptable, and capable of long-term success, and that ultimately is the objective. At this stage, it is essential to connect everything discussed to a single unifying principle. Survival is the only prerequisite for success in trading. Without survival, nothing else matters. Not your strategy, not your analysis, not your edge. If your capital is depleted, the game is over. This may sound obvious, but most traders do not operate with this principle at the center of their decision making. They operate with a hidden objective, which is to maximize short-term returns. This leads to behavior that directly contradicts survival. They increase position size after wins, they chase performance, they take marginal trades to stay active. Each of these decisions slightly increases risk. Individually, they may seem insignificant. Collectively, they create a fragile system that is highly exposed to adverse sequences. Professional traders operate differently. Every decision is filtered through one question. Does this increase or decrease the probability of long-term survival? If it increases survival, it is considered. If it decreases survival, it is rejected, regardless of potential upside. This creates a natural discipline. It removes impulsive behavior. It aligns every action with a long-term objective. This approach also creates clarity. You are no longer trying to optimize for multiple competing goals. You are optimizing for one thing, which is staying in the game. Profitability then becomes a function of time and consistency, rather than a function of aggressive risk-taking. There is a concept closely related to risk of ruin that is worth understanding deeply, and that is risk tolerance versus risk capacity. Risk tolerance is psychological. It is how much loss you feel comfortable with. Risk capacity is structural. It is how much loss your capital can actually sustain without compromising your ability to continue. Most traders confuse the two. They base their position sizing on what feels acceptable rather than what is mathematically sustainable. This leads to inconsistencies. In calm periods, they may feel comfortable taking more risk. In volatile periods, they may reduce risk excessively. Both behaviors are driven by emotion rather than structure. Professional traders anchor their decisions in risk capacity, not risk tolerance. They define their maximum acceptable drawdown based on capital preservation and then work backwards to determine appropriate position sizing. This creates a consistent framework that is independent of emotional fluctuations. Over time, this consistency builds confidence. Not the confidence that comes from winning trades, but the confidence that comes from knowing your system is robust. That confidence is far more valuable. It allows you to execute your strategy without hesitation, even during difficult periods. Another important aspect is the role of discipline in enforcing your risk framework. A well-designed system is only effective if it is followed. This may sound straightforward, but in practice it is one of the most challenging aspects of trading. Discipline is not about willpower, it is about structure. Professional traders reduce the need for willpower by creating rules that are clear, simple, and enforceable. They automate where possible. They use predefined position sizing models. They set limits that cannot be easily overridden in the moment. This removes decision-making from high-pressure situations. Instead of asking whether to reduce risk after a series of losses, the system already dictates the response. This consistency prevents emotional escalation. It ensures that risk remains controlled even when conditions are difficult. Without discipline, even the best risk framework will fail. With discipline, even a simple framework can be highly effective. This is why professionals place so much emphasis on process. They understand that execution is what determines outcomes, not intentions. Let us now consider the impact of external shocks. Markets are not always driven by gradual changes. There are periods where unexpected events cause rapid and significant price movements. These events are difficult to predict and often occur outside of normal market hours or liquidity conditions. From a risk of ruin perspective, these events are particularly dangerous. They can lead to gaps in price where positions are filled at levels far worse than expected. Stops may not be executed at intended levels. Losses can exceed planned risk. Professional traders account for this by incorporating a margin of safety into their risk framework. They do not assume perfect execution. They allow for slippage and gaps. This often means risking less per trade than theoretical models might suggest. They also manage exposure around known event risks. Major economic releases, central bank decisions, and geopolitical developments can all increase the probability of large moves. Reducing exposure during these periods is a proactive way to manage risk. The key principle is that not all risk is visible. Some risks are latent. By acknowledging their existence, you can structure your trading in a way that reduces their impact. There is also a cumulative effect of small mistakes that contributes to risk of ruin. It is rarely a single catastrophic decision that destroys an account. More often, it is a series of small deviations from the plan, slightly increasing position size, holding on to losing trades a bit longer, taking trades that do not fully meet criteria. Each of these actions increases risk incrementally. Over time, these increments compound. The system drifts away from its original design. Risk becomes misaligned with capacity. Eventually, a normal losing sequence occurs, but the system is no longer robust enough to handle it. Professional traders are highly aware of this drift. They monitor their behavior closely. They review their trades regularly. They identify patterns of deviation and correct them quickly. This constant calibration keeps the system aligned with its intended structure. This is why journaling and review processes are not optional. They are integral to managing risk. They provide visibility into your behavior and allow you to make adjustments before small issues become large problems. Another dimension to consider is the relationship between confidence and risk. Confidence can be beneficial when it is grounded in process and experience. However, overconfidence is one of the most dangerous factors in trading. After a series of wins, traders often feel that they have a stronger understanding of the market than they actually do. This leads to increased risk-taking. Position sizes are increased, rules are relaxed, and caution is reduced. This is precisely the point where risk of ruin begins to rise. The market does not reward confidence, it rewards consistency. Professional traders maintain a level of humility regardless of recent performance. They understand that outcomes are influenced by both skill and randomness. They do not assume that a winning streak reflects improved ability. By keeping risk constant, they prevent overconfidence from affecting their decisions. This stability is what allows them to navigate both winning and losing periods without significant changes in behavior. It is also important to understand that reducing risk does not mean eliminating opportunity. There is a misconception that conservative risk management limits potential returns. In reality, it enables them. By preserving capital, you maintain the ability to take advantage of future opportunities. Markets are continuous. There is always another trade. The objective is not to maximize the outcome of any single trade, but to maximize the outcome of the entire sequence. Professional traders think in terms of sequences. They understand that missing one opportunity is irrelevant in the context of hundreds of trades. What matters is maintaining a stable process that can capture opportunities consistently over time. This perspective reduces pressure. You are not reliant on any single outcome. You are focused on executing your process repeatedly. This consistency is what generates returns, not isolated moments of success. Let us now bring this into a practical framework. When designing your trading system, you should start with risk, not strategy. Define your maximum acceptable drawdown. Determine your risk per trade based on that drawdown. Assess how many consecutive losses you can sustain within that limit. Once this structure is in place, you can then build your strategy within those constraints. This ensures that your approach is inherently aligned with survival. It prevents you from developing strategies that are profitable on paper but unsustainable in practice. This risk-first approach is a hallmark of professional trading. It ensures that every aspect of your system is built on a stable foundation. It removes the need for constant adjustment and reduces the likelihood of structural failure. It also simplifies decision making. When risk parameters are clearly defined, many decisions become automatic. You know how much to risk, when to reduce exposure, and when to step back. This clarity is invaluable in a complex and uncertain environment. As you integrate these principles, you will begin to notice a shift in how you perceive the market. It becomes less about prediction and more about management. You are no longer trying to forecast every move. You are managing your exposure to uncertainty. This shift reduces stress. It creates a sense of control, not over the market, but over your own actions. And that is the only control you truly have. By focusing on what you can control, you eliminate a significant source of frustration and error. You will also find that your performance becomes more consistent, not necessarily in terms of returns, but in terms of behavior. You execute your strategy more reliably. You adhere to your rules. This consistency is what leads to long-term success. Risk of ruin, when properly understood, is not a limitation. It is a guide. It directs you towards behaviors that are sustainable and away from those that are destructive. To conclude, risk of ruin is the central framework through which all professional trading decisions must be viewed. It is the mathematical and behavioral boundary that defines what is possible over the long term. Ignore it, and even the strongest edge will fail. Respect it, and you create the conditions for compounding, consistency, and longevity. Every concept discussed throughout this lecture, position sizing, drawdowns, volatility, correlation, discipline, ultimately feeds into this single objective: survival. It is the foundation upon which everything else is built. As you move forward, carry this principle into every aspect of your trading. Before you think about profits, think about preservation. Before you think about opportunity, think about sustainability. This is not conservative thinking, it is professional thinking, because in the end, the traders who succeed are not the ones who make the most in the shortest time. They are the ones who remain consistent over the longest time, and that consistency is only possible when risk of ruin has been systematically removed from the process.